Welcome back to The Explainer. Today we are taking a fascinating, incredibly high-stakes look into Novartis. This is a Swiss pharmaceutical giant that is literally navigating one of the most challenging transitions in its entire corporate history. I mean, imagine having one of the best-selling products in the entire world, right? Only to have the legal shield protecting it suddenly vanish into thin air. That is the dreaded patent cliff, and it completely opens the floodgates to aggressive generic competition. Right now, Novartis is in the fight of its life to protect its legacy revenues, all while desperately racing to bring its next generation of blockbuster drugs to market. It's a classic problem and solution narrative, and it's playing out in real time. So let's break down exactly how they are handling the pressure.
Okay, let's look at our roadmap for today. First, we have a tale of two stories, then Q2 winners and losers. Next up is the $10 billion pipeline, followed by the UK patent victory, and finally, we will wrap up with the verdict on Wall Street. Section 1. A tale of two stories. Let's look at the Q2 2026 earnings.
Setting the stage with their recent Q2 2026 earnings report, we immediately see a massive contradiction. On the top line, Novartis looks absolutely incredible. They delivered net sales of $14.4 billion, which is a 3% increase, beating Wall Street expectations outright. But wait, look right below that at the net income. It took a severe 19% hit, dropping down to $3.26 billion compared to the previous year. Meanwhile, core operating income held flat at $5.94 billion, which, again, actually beat analyst predictions. So what exactly is happening here? I mean, how do you beat revenue expectations but see your net income fall off a cliff? It all comes down to the massive transitional strain the company is under right now.
Which brings us to Section 2, Q2 winners and losers, the shifting revenues.
To really understand that income drop, we've got to look at the specific drugs driving these tectonic revenue shifts. On one hand, we have the undisputed winners. Novartis's oncology portfolio surged by a massive 35%. Just listen to these numbers. The breast cancer drug Kisqali jumped 44%. The leukemia drug Scemblix soared an unbelievable 89%. Pluvicto for prostate cancer climbed 43%, and Kesimpta for multiple sclerosis grew 32%. But on the flip side, we have the losers. These are the older cardiovascular treatments that are just bleeding revenue due to generic erosion. Drugs like Entresto, Promacta, and Tacitina are falling, and they are falling fast. And that brings us to this dramatic number, 50%. That is the breathtaking plunge in sales for Entresto in just one single quarter. This was Novartis's former top revenue generator, accounting for roughly 10% of their total sales. But because of U.S. generic competition, its revenue was literally slashed in half, down to $1.18 billion. And it wasn't alone, right? Promacta fell by 64% and Tasigna dropped by 57%. So you see, the patent cliff isn't just some abstract theory for Novartis. It is a brutal financial reality eating away at their foundational revenue.
Which makes this context from the C-suite absolutely crucial. CFO Mukul Mehta gave a heads up that Q2 actually enjoyed some temporary sales and cost benefits that artificially boosted operating profit by about 5%. But those benefits? Yeah, they're expected to completely reverse in the second half of 2026 as Novartis heavily increases their R&D and new launch spending. However, here's the wild part. Despite the crashing older drugs and the upcoming expenses, CEO Vas Narasimhan is remarkably confident. He formally reaffirmed the company's full-year 2026 guidance.
Moving on to Section 3, the $10 billion pipeline, where we talk future growth.
So, the million-dollar question, or rather, the multi-billion-dollar question, is how exactly do they plan to replace that lost revenue and justify the CEO's confidence? Well, investors are laser-focused on these three experimental late-stage drugs. First, we have pelacarsen for cardiovascular disease, then remibrutinib for multiple sclerosis, and finally, del-desiran for myotonic dystrophy type 1. Together, analysts estimate these three therapies represent a staggering $10 billion peak annual sales opportunity. Clinical readouts for these trials are expected in the coming months. And make no mistake, the results of these trials are absolutely going to make or break Novartis's ability to sustain growth well beyond their current patent cliff.
But they aren't just sitting around waiting for trial results. They are actively putting wins on the board globally. Repsido just got approval in Europe and Japan. The European Commission greenlit the gene replacement therapy Itvisma. Over in the U.S., a biologics license application for del-zota was submitted to the FDA seeking accelerated approval. And incredibly, Core-Tem Baby, which is the very first anti-malarial developed specifically for newborns, was pre-qualified by the World Health Organization. This regulatory momentum is actively reinforcing Novartis's pipeline all over the globe.
Now let's talk shopping sprees. CEO Narasimhan is aggressively using strategic deals to buy innovation. Step 1 was a massive $12 billion acquisition of Avidity Biosciences to really strengthen their late-stage neuroscience pipeline. Step 2 was agreeing to acquire Myrex Bio, a biotech specializing in antibody-drug conjugates for cancer. Step 3 was a $105 million collaboration with Antares Therapeutics for precision oncology. And Step 4 was the strategic acquisition of a breast cancer pipeline asset from Sinovation Therapeutics. They are meticulously filling the gaps the patent cliff is creating, piece by piece.
All right, Section 4, the UK patent victory and protecting Entresto.
But, invention and acquisition are really only half the battle here. While scientists in the labs are inventing new drugs, the corporate lawyers are fighting tooth and nail to protect the old ones. Take this high-stakes legal battle over Entresto in the United Kingdom. Accord Healthcare, which is part of India's Intas Pharmaceuticals, tried to launch a generic version of Entresto in the UK. Now, Novartis's base European patent for Entresto actually expired back in 2023. But in August 2026, the UK High Court handed down a decisive victory for Novartis, ruling against Accord's challenge. This ruling effectively blocks generic competition and buys Novartis critical time in the UK market all the way until 2028.
So how did they pull that off? It all comes down to this concept, a Supplementary Protection Certificate, or SPC. This is a specific intellectual property right that basically serves as an extension of a patent. It's intended to compensate for the long regulatory delays drugs face before they can even be sold. Accord tried to have this SPC declared invalid, but Judge Richard Mead completely rejected their attacks, upholding the validity of the SPC and ruling that Accord's intended generic would infringe on Novartis's legal rights.
Legally speaking, the ramifications of this are totally fascinating. The UK ruling mirrors a similar victory Novartis had in the Dutch Court of Appeal. However, it sits in sharp contrast to the United States, where Novartis actually lost a similar bid to block generics, which, if you remember, is why U.S. Entresto sales fell by 50%. Furthermore, for the pharmaceutical industry at large, this case provides fresh UK legal guidance on the concept of plausibility in patent litigation, specifically for complex combination drugs like Entresto, which combines two different active ingredients.
Finally, Section 5, the verdict on Wall Street. Let's look at market sentiment.
So, we've seen the plunging revenues, the surging oncology pipeline, the M&A shopping spree, and the courtroom drama. How are financial markets absorbing all of this data? Honestly, analyst sentiment is incredibly mixed. 7 analysts are telling investors to buy, 7 are advising to hold, and 2 are slapping a sell rating on the stock. This perfectly split sentiment results in a consensus hold rating, with an average price target hovering around $141.20. Wall Street definitely sees the promise, but they also see the massive hole left by Entresto, and they are essentially waiting to see who wins this high-stakes tug-of-war.
But wait, contrast that cautious analyst rating with the actions of heavy-hitting institutional investors. Mira Asset Global Investments, for example, aggressively increased its stake in Novartis by 40.4% in the second quarter alone, scooping up over 56,000 additional shares. Now, when you are looking at a company with a massive $292 billion market cap, that kind of institutional buying signals serious confidence. The big money clearly believes in the CEO's pivot strategy and the strength of that upcoming pipeline.
So Novartis is truly at a pivotal moment. The tension is palpable. On one hand, you have the staggering loss of billions in legacy revenue to generic competition. But on the other, you have a company fighting back with brilliant legal maneuvers to buy time, an oncology portfolio delivering explosive growth, and a $10 billion pipeline right on the brink of vital clinical readouts. The second half of 2026 is going to be absolutely critical. So I leave you with this to ponder. As the R&D costs climb and the generic pressure mounts, will Novartis simply survive this transition game, or will they reinvent themselves and emerge even stronger? Thank you so much for joining me for this explainer. I hope this helped clear up the complex mechanics behind one of Pharma's biggest transitions.